Banks. Now, as we heard earlier, the Serious Fraud Office is now looking into whether there are grounds for criminal charges over the LIBOR fixing scandal. Whether or not the police become involved, the banks, their executives and workers could find themselves in court to face civil cases. At the same time, banks are likely to have to make substantial payments over the mis-selling of interest rate swaps products. The final bill could run to millions, if not billions of pounds, a devastating blow to an industry still paying out compensation for mis-sold payment protection insurance. Well, joining me now is Akram, principal at the city law firm LEXLAW, which is representing many clients who claim to have been mis-sold products. Nice to see you. Thank you for coming in. Just remind us what your clients are saying happened to them and why they want compensation.
Okay. Well, I act for a range of clients, SMEs throughout the country, the backbone of the UK economy. They say small businesses to medium-sized enterprises, and they say that when they've approached banks for loans, they've been told by banks they must enter at the very last minute that they must enter into a derivatives hedging contract. The consequences of that are not fully explained to them. The contingent liabilities that are consequent upon entering into that contract are not fully disclosed to them. And I've heard this story on a daily basis.
So when it all goes wrong for one of your clients, what happens?
Well, the clients are faced with a number of choices. One is complaining internally to the bank, which the vast majority of them have done so unsuccessfully. Secondly, complaining to the Financial Ombudsman Service, which some of our clients have done. Again, the vast majority of which have been unsuccessful. And the third option is issuing litigation against the banks. In these instances, where litigation is issued against a bank that's been accused of mis-selling swaps, in the vast majority of cases that have come to the courts, there's been a settlement prior to judgment being issued.
So the banks have caved in?
Yes, the banks have absolutely caved in.
Now, what I find so interesting about this is that I'm paid to know what interest rate swaps are, and I'm not sure that I do. But if I were running a small butcher's shop and I went for a loan and I was told this I needed to buy, I wouldn't have a clue what was on offer.
Well, I mean, in that specific case, the bank attended the butcher's shop and did a presentation. So they had a laptop, I believe they pulled it out and did a presentation of a number of different products to a butcher.
They couldn't want a loan.
All they wanted was the loan. But what the bank wanted, they knew that the customers were unsophisticated, that they wouldn't dispute the margin. They would dispute the margin, but they wouldn't know what they were entering into in terms of the derivatives. They could take advantage of that and make great profits.
So once again, we had the PPI scandal, the insurance loan scandal. Then we had this interest rate swap scandal. Now we've got LIBOR, rate fixing scandal, all within a very short period of time. Is it your sense that the banks are in fact just a sort of cesspit of corruption?
I can't make that judgment call, but going back to 2005 to 2009, when the LIBOR rigging occurred, which we know from the FSA, and going back to the same a very similar period, 2005 to 2008, when my clients became victims of the major four banks, the banks were being run in a way which their conduct was clearly reprehensible.
So what kind of compensation are your clients being paid once the banks have said, oops, yes, we really did do it?
All my clients tend to want is to be put back in a position. They want to carry on paying on the loan. They want to be put back in a position, perfectly reasonable position, that they would have been in had they never entered into the swaps contract. And that effectively means that all the payments that they've made out under the swap, several of our clients, that amounts to hundreds and hundreds of thousands of pounds.
Really, that much?
Absolutely, yes.
That's how much they've paid out?
Yes. And then on top of that, they want to be relieved from this contract. So they want to rescind the contract and not be liable for the break fee. So the contingent liabilities that the banks have imposed upon them via the swaps contract, they want to be free of them. And those can amount, for example, in the case that has been discussed with Sky News, in that case, the loan was 1.4 million, the break fee was 600,000. Those are the approximate figures. So
what advice would you give to viewers tonight watching this show thinking, hang on a minute, that happened to me?
I think they need to take action. The FSA...
What kind of action?
Well, the FSA announced at the end of last week, after an investigation that took a couple of months, that there would be a redress scheme that they'd made in agreement with the banks. But an organisation which represents the banks, known as bully banks, have made it clear that they believe that that this scheme is fatally flawed because it hands control to the banks themselves to conduct their investigation, and it says if you're not happy with the results, complain to the Financial Ombudsman Service. Well, that's always been the position, so they're extremely unimpressed with that scheme and they wish for better redress.
It sounds to me like the old advice you used to get in the States: don't hesitate, litigate. Ali, nice to see you. Thanks for coming.